Silver didn't really move this week, but don't confuse stillness with stability. What you saw wasn't boredom, it was tension. Silver didn't throw a tantrum because traders got emotional. It moved the way it did because someone, somewhere, realized something important. This market is no longer about price, it's about access. Over the last several sessions, silver behaved like a live wire. Margin adjustments, whispers of export controls, quiet talk of prepayments to mines. None of that is normal noise. That's a signal. When markets are speculative, they're loud. Everyone's chasing, everyone's talking, everyone thinks they're early. But when a market turns strategic, it goes silent. It becomes paperwork, policy drafts, closed-door calls, contracts that never show up on a screen. That's exactly what we're seeing in silver. Most headlines still treat silver as small, easy to push around, easy to ignore. That's a mistake. Silver isn't small, silver is thin, and thin markets don't absorb shocks, they snap. Think of silver like a narrow bridge over a canyon. It doesn't matter how strong the steel is. If you send a stampede across a bridge built for bicycles, it doesn't bend, it breaks. Now look at demand. Industrial demand doesn't negotiate with charts. Solar panels don't pause because sentiment looks ugly. Electronics don't wait for a better entry. Defense procurement doesn't cancel orders because volatility picked up. When demand doesn't blink, supply becomes the only variable left, and the real question becomes simple. Who controls it? Who secures it? And who gets cut off first? This is where Latin America enters the picture, because silver rarely comes out of the ground alone. It comes bundled. Silver, copper, lead, zinc, the entire toolkit modern industry needs. That's why this isn't just a silver story. Silver is the doorway. Behind it is the hallway of critical materials that keep economies running. Now hold on to this thought. If supply chains in Latin America get squeezed, what else gets squeezed with them? Because here's where things get uncomfortable. We're hearing about export controls in the same breath as margin hikes. That combination matters. Margin changes are a market tool. Export controls are a state tool. When those two start moving together, you're no longer watching price discovery, you're watching power discovery. And the most sensitive wire in that circuit is Taiwan. People avoid connecting these dots because they're inconvenient, but the linkage is real. Resources buy influence, influence buys votes, votes buy legitimacy, legitimacy buys time, and time is the most valuable currency when red lines are involved. Latin America isn't just about mines and ports, it's about alignment, trade routes, security relationships, quiet promises that never make headlines. So when silver supply chains tied to Latin America start showing stress, you're not watching a commodity story, you're watching a chessboard shift. And when the chessboard moves, Taiwan stops being a headline, it becomes a clock. Now let's talk about the warning signs hiding in plain sight. First, volatility that doesn't look speculative. There's no frenzy, no bragging, no retail stampede. This feels like professionals hedging risks they can't model. Second, inventories that don't reassure. Thin buffers turn volatility into a flare. Paper can keep trading, physical can't. That's where rationing begins. And when rationing begins, price becomes secondary. Third, direct prepayments. When industrial buyers pay mines up front, they're not timing dips, they're securing oxygen. That's not a trade, that's survival. And once one major player does it, others follow, because no executive wants to explain why a billion-dollar factory can't run. Now consider something else the market celebrated for the wrong reason. A major tech manufacturer in Asia was praised for being back. Shares jumped. Optimism followed, but beneath that celebration is the real story. Next-generation memory, advanced hardware, battery technology that changes charging behavior. Better batteries don't just improve convenience, they accelerate adoption. That means more pressure on materials, more strain on supply, another mouth at the table. So ask yourself honestly, when silver demand becomes structural across energy, transport, and defense, who gets priority? A brokerage account or governments and corporations that can sign contracts and redirect flow? That's the shift, and it's why daily price chatter is a distraction. Markets can print numbers, they can't print metal. Now let's briefly look at the tape. Silver has been respecting technical levels unusually well. That's not normal. Silver is usually chaotic. But right now, levels are being defended. That suggests big money isn't charting for fun. They're using levels as battle lines. Push through, trigger stops, collect inventory, snap it back. That's extraction. And when reclaimed levels hold longer, it tells you something else. Stronger hands are defending higher ground. This isn't about a 15-minute chart. It's about stress elsewhere showing up on the screen. So what actually matters? Watch real switches, not sentiment. Firm export actions, more long-term off-cake deals, tariff escalation spreading regionally, energy policy shifts that change cost structures, and above all, watch the physical signals, premiums, delivery delays, allocation language. When dealers start sounding like ration offices, the chart becomes theater. Now let me leave you with two questions. If paper prices fall, but real-world premiums don't, who's lying, the screen or the shelf? And second, is this really about a metal or about a map? Comment metal or map and tell us why, because how you answer that question determines how you panic at the wrong time. Volatility creates fatigue. Fatigue creates mistakes. We don't follow narratives, we follow mechanics, and the mechanics are telling us something important. Silver isn't screaming, it's whispering. And the last thing I'll say is this: the next phase won't arrive loudly. It won't ask for permission. It'll show up as a small headline and hit the market like a hammer. Not because the price moved, but because someone couldn't get delivery. That's the moment people finally learn the difference between a chart and a shortage.